Thanks for being here today. Happy to discuss this project with you all and talk through self-storage and opportunity zones generally. So this project is a project in Lansing, Michigan, which is the state capital of Michigan. It's also where one side of my family lives, so it's an area that we know very well. While Kansas City's home number one, this is kind of home number two for me. And so we're still doing deals in our backyard, so to speak. This property is a 838 unit self-storage redevelopment that has already been completed by a group, Midwest Self-Storage, that has done excellent jobs doing projects much like this one. And so we have been working with this group for some time now to come together on this project. And have found a way where we can have a benefit of opportunity zone investment for our opportunity zone investors, as well as having the ability to utilize an existing asset that has begun to cash flow already. So a bit about this project was completed in late 2019. It has gotten its C of O in March. And then began leasing in April. And since that time, it has leased up to be just over 26% occupied as of September, which is a substantial leasing activity for any facility to be, 26% occupied. As kind of a reference point, we typically say facilities going to lease up 2 to 3% per month. So this is in an opportunity zone in an area in Lansing, Michigan. That's a nice retail corridor. You got Kroger across the street, a new kind of renovated shopping center across the street, and an area that has incredibly high traffic and has generated incredibly high traffic year over year. Additionally, we are catty corner from another self-storage facility that has leased up to full occupancy in relatively short order, and we are anticipating that we'll be able to do the same. A bit about the structure. So we have a piece of this property, which is raw ground. It's a pad site. And so our opportunity zone dollars are going to go into this pad site while getting a carried interest for those same investors into the parcel that owns the storage. And so that allows us to both get the benefit of opportunity zone as well as get the benefit from the existing cash flowing asset. So again, here's some of those highlights. We discussed a few of these, but this is already open and leasing and has done very well. Extra Space Storage is the second largest owner of self-storage in the world. The largest third-party operator. They consistently deliver higher NOI on same store than its peers. So huge fans of Extra Space Storage. We've been talking to them about some other opportunities here in Kansas City, and we're excited to be working with them. This is in a qualified opportunity zone, and we are able to structure a component of this investment as an opportunity zone investment. And we can talk through what some of those returns look like, or those benefits are. Self-storage is a resilient asset class. And what we mean by this is that in previous recessions, self-storage has fared well. And so, you can kind of talk through a little bit about why self-storage does well. But if you think about it this way in its simplest terms, when things are going well, people buy toys and they need a place to store them. When things are going poorly, people often have to downsize but don't want to give away their things. And so they have to have a place to store them. And while they may not be able to afford a $2,000 apartment anymore, they can afford a $200 storage unit while they're living with mom and dad. De-risked asset. So part of the de-risk is that we're going into this asset where we are leasing up already, as opposed to kind of coming in earlier on an opportunity zone deal where you have to add a substantial amount of improvement, and then you have an issue of potential lease up issues. Well, we're kind of de-risking some of that by going into a facility that's already there, it's already leasing, and then we have the ability to implement even more value on the pad site. And then again, this is a strong retail corridor. Retail corridors are hugely important for self-storage. Self-storage has largely become a retail type asset class, and more retail oriented facilities perform far better than industrial type facilities. So high level on the offering summary, we're targeting a 3.15 investor multiple over a 10-year hold, 21.5% average rate of return. We're acquiring the property at $8.9 million total, which includes some additional due diligence costs, reserves for interest and operating expenses, et cetera. We'll deploy $1.1 million into the pad site parcel, and then we'll retain a profits interest in the parcel with the self-storage. We'll get into that a little bit But effectively, we're structuring it such that if there was one waterfall to meet both the pad and the storage facility, we're structuring it such that we can have the smoothest waterfall between the two with kind of a creative mix of shares. This is an interesting property or an interesting strategy where the sellers are actually staying in the deal with us. And so the sellers have a pref equity investor that has been kind of the largest investor in this deal as they went through the development process. We are taking them out and then putting new debt in place. But the majority of the actual development team is keeping their 1.1 million in the deal. Additionally, FTW and one of our other partners has $200,000 into the deal as well. So the strategy really is we're going to lease up the facility to a point where we are stabilized. We'll then refinance that facility, hopefully being able to return all the invested capital at that point in time. And then we'll continue to hold that facility up to 10 years where our investors will benefit from the cash flow of that asset. So a bit about the structure here. So the investors here will put the OZ money into the OZ fund, including our money that will go into the QOZ fund. One misleading piece here is there's actually kind of a skip step there where the non-QOZ money is actually going to come directly from the investors into the 930 West Homes LLC. And we can talk about that, but any money that's going to go in that's non-OZ money won't flow through the fund, but will go directly into 930 West Homes LLC. The Opportunity Fund will then make its investment into 930 Homes Pad Developer LLC, which will own the pad site and will be a qualified Opportunity Zone business. Our money and our non-OZ money and the seller's non-OZ money will be going directly into 930 West Homes LLC. And again, here at this level, you'll see that we have these two different entities to meet those OZ requirements, and there will be carried interest across each to smooth out that waterfall. So on this property, we're paying a 10% preferred return to investors with a 70-30 LP-GP split. What that means is over and above a 10% annualized return to investors. Investors continue to receive 70% of the cash flow. We receive 30% of that cash flow. On a refinance or sale event, first, the investors will get a preferred return caught up in the event that we haven't paid the preferred return current. Then they will receive a return of their invested capital and then 70% of the profits from there forward. We are targeting an equity multiple of 2.1 overall for the equity investors with an average annual investor rate of return of 23%. So here's kind of a little bit of sources and uses. We'll talk through this a bit here, but effectively you'll see we have 1.1 of kind of seller equity, 1.1 of investor equity, $200,000 of our money, and a $6.5 million loan. That makes up the purchase price, the operating reserves, and all other items to get to the finish line. We're not charging an acquisition fee on this one. We're not charging a development fee on this one. Extra Space will take a 6% annual management fee. We will charge a 1% asset management fee to the investors. So here's a big cash flow spreadsheet. You can look at this yourself.
A lot of numbers.
A lot of brain damage for a presentation, but this is something that can be available. And these are the kinds of things that we share with investors for them to be able to predict out what the cash flow is going to look like.
Yeah, Parker, I think the one thing I want to talk about, though, is as you look at the total revenue, the big opportunity here is obviously to get the property leased up. And so you'll see the revenue continue to increase over the 5 years. At what point do self-storage facilities typically get leased up, and where do we kind of hit our break-even point on this?
So we'll hit our break-even point in the second year. One thing to note about this cash flow model is it's actually starting under the basis that we are 0% occupied. And so since they have gone in and leased up to 26%, we're actually starting ahead of schedule on this cash flow spreadsheet here. So we'll actually be ahead of where these projections look. Most self-storage facilities, we say stabilize within 3 years. With the current lease up, if we maintain that, we would be able to stabilize within 2. So here's a sheet that outlines kind of a projected return on an investment. Again, we can provide this to you. It's a lot of brain damage for a presentation.
Yeah, I think the view that I like to show here is we get a lot of questions on a regular basis that, sure, we see the IRRs, we see your average annual returns, we see all these return on investment metrics. What this actually does is breaks out what would $100,000 investment actually look like, and what does that feel like to you. So just taking that overall investment and breaking it down into what we'll call investor shares is the goal of this.
And this is a lease up schedule based on Extra Space's original forecasts, or their updated forecast as of April. Clearly, we are ahead of schedule on this, but this is something that, was kind of a standard curve. This is a bit of a seasonal business. And so we do typically anticipate that you're going to see a little bit lower occupancies in the winter months. Lansing is also East Lansing is Michigan State University, which is a 40,000 person campus. This year we saw about an 8% uptick in occupancy during the summer months that dropped down to about, we lost about 6% of that once school went back into session. But again, we're still at that 26% after those students have even come back and got their stuff and got their new dorm rooms.
So
All right.
Yeah, go ahead.
Oh, I was just going to say thank you, Parker, for walking us through that. And I was going to hand it over to Ang to talk a little bit about opportunity zones and tell everybody why Sean Parker and Alexandra Parker are on our slide.
Well, I just want to give a little background about myself. I am the out-of-stater here. I'm from California, and I was in Apple. I was working at Apple, leading data science for Siri, and we as tech employees, and at least when I was a tech employee, we get compensated a lot with RSUs and stocks. And Sean Parker, who's ex-president of Facebook, got compensated a lot with Facebook stock. One of my good friends is a lobbyist, and he told me of a story of how Sean and a few of his Silicon Valley co-CEOs and execs lobbied for the opportunity zone law in the 2017 Trump tax bill. I think it paid off very well for him. But the intention of the law is really to provide economic incentives for investors such as ourselves and yourselves to go into areas that's dictated by the local governments to help improve those areas. And I think that's what we're trying to do here as well. Can you go to the next slide? So this is the map of the opportunity zones. And it's interesting that it is still very much dictated by the local government. So you still see opportunity zones in good areas. It's not necessarily that an opportunity zone is just an area that no one wants to invest in. It's an area that needs more investment. Next slide. I like to talk about tax benefits, and hopefully when you guys invest in real estate, you guys are all thinking about the tax benefits of real estate investing. Opportunity zones present a really unique new feature. There's 3 really great ways to benefit from investing in an opportunity zone. The first, and my favorite, is tax deferral. We do a lot of things in our lives that's basically about deferring taxes. We invest in 401ks, which is essentially a deferral of taxes. And this is similar. When you sell a stock or another real hard asset, you have to pay capital gains on that. Hopefully you are making money from that. But instead, you could invest those capital gains and then defer your taxes up until the end of 2026. At that point, after you held it for 5 years, your taxes get reduced by 10%. And then if you hold the opportunity zone for 10 years, all future capital gains gets eliminated in terms of tax treatment. So that's a three-parter of how opportunity zone benefits you as a taxpayer. It's a really great opportunity, and it's novel. It's just launched at the end of 2017. And so the eligible gains, just to highlight, sell real estate. Not a lot of people do that part because there's still the 1031 sell of businesses. And my favorite, sell of stocks. As somebody who owns a lot of stocks, it qualifies for both short-term and long-term capital gains. And I just want to highlight one last thing here. The IRS has extended the 180-day rule. So essentially, when you sell a stock from the date of the capital gains, you have 180 days to then invest it in a qualified option zone fund. But with this latest IRS notice, and this is very specific for the COVID period, you have 180 days, and if it falls after April tax day, April 15th, then you are able to extend it to the end of the year. The net of it is if you had gains from sale of stocks from even as far back as late last year, 2019, it could qualify if you invested before the end of this year. So there's a lot of additional information in these slides on qualified option zones. I'm not going to read through all these, but I really love to, see. I would love to present this because this is a really unique opportunity. A lot of people know about it now, but very few people are able to find great investments like this. Yeah.
All right. Well, thank you, Ang, for highlighting that. And it's very near and dear to your heart, obviously, being in California and in the tech world. I think that it's the opportunity zone when it first came out was very much a buzzword, and there was a lot of politics involved in it. Still is, but at the same time, when you're actually able to identify a project that not only is going to help the community, it's going to help investors, and it's going to beautify the area that you're investing in. It's really a win-win-win, and I love doing those types of projects. Parker has coined a term, doing well by doing good, and maybe that's backwards. Maybe it's doing good by doing well. But I do really enjoy that part of the commercial real estate world that we actually get to participate in. With that being said, I want to have Parker talk a little bit about Lansing, Michigan, which, just like not a lot of folks know Missouri, the capital of Missouri is Jefferson City. Not a lot of folks, I think, knew that or know that Lansing, Michigan is the capital. So, Parker, why don't you jump into Lansing and talk a little bit about this market in general?
Absolutely. So Lansing is state capital of Michigan, is Logan had just mentioned. And why we like that is, especially in times of potential economic turmoil, we like to look for what we'll call kind of institutional base of employment. And so in Lansing itself, you have the state of Michigan. I mean, you have the entire, state government in Lansing. You also have Michigan State University, and both of those are large institutions that then have feed off employment. So you have a large healthcare system, you have large school systems. And so you have a lot of infrastructure there to continue to support the town, even in times of trouble. Lansing has done very well over the last decade, and we think will continue to do well. But we really like the steady population growth and the resilient job base that we have here. So, a bit more about Lansing. Again, you see here kind of GM, Sparrow Health, auto owners insurance, a lot of health and government and school employment. And those are things that are going to last kind of at all times. This is a population of about 485,000 in the metro area, with a population of 118,000 people in Lansing itself, which we think is a great size to continue to support itself as a metro area. But again, if you look at these, demographics, the population increase of 4.45% has been solid. And so we've seen, consistent growth in the population, which means that, the town is going to grow to support that as well. Again, a little on demographics here. So if we want to talk through the household income kind of demographic, I think is one thing that we look at a lot. So first when we look at any self-storage property, and we'll talk about this here next. But we look at what the population is, and we compare that to the statistics on demand drivers for self-storage. And so, from population and household info, we can project out what the demand is going to be for self-storage, and we can subtract that from what the existing supply and pipeline of supply is for self-storage to determine a gap in the marketplace, right? So we're going to do that. We'll talk about our competitive set here in a second, but I want to call that out when you look at this population so that we can see what we're comparing here to what we're going to show you on the next slide. Another thing that's interesting and important is median household income. So when you look at the demographic breakdown for self-storage customers, you might think, the highest income is better, multifamily or an office or retail. A lot of times people will focus on kind of 75,000 plus average household incomes. Those are not actually the best customers for self-storage. In fact, people who make between $30,000 and $60,000 are the most likely consumer of self-storage. And so what we look for are areas where we're going to fit within that demographic and have kind of the most robust demand. And here's our kind of competitive set. This shows you where the competitive properties are in our kind of trade area. The closest facility to us is another Extra Space facility across the street from us. In fact, this is a stabilized facility. That owner has actually offered to purchase our property, but we are clearly buying it ourselves. So we have a competitor that's close by. But basically how this is going to work is between that property and our property. These are both Extra Space managed properties. They're going to be kind of co-managed. And so if someone goes over to the property across the street and they don't have a 10 by 10 available, they'll come over to us and rent a 10 by 10. And so we have the ability to frankly capture a much larger marketing area with having some density of Extra Space facilities in this area. Everything else is, about 2 miles out, which means that kind of within our tight knit area, we are the most competitive facilities in that corridor. So here's a map here. So this property sits right on the northeast corner of Martin Luther King Boulevard and West Holmes Road. So again, on the southwest corner is where you'll have another facility here. And then we have a pad site there. If you see the Little Caesars Pizza, that pad site to the right of it is the pad site that we have. And so our intention for that pad site as we go forward, you can switch to the next slide if you would, Logan. So here's the pad site here. This is a little bit older photo. All this parking has been completely redone with all new landscaping all throughout the whole facility. And this pad site that we have here, we will be putting all the OZ fund money. This is a spot where we've already identified some potential retailers as well as medical office tenants who are looking for a space. And we have the ability to do a build to suit for lease. That's actually not in our cash flow model. So we have not calculated any cash flow to be derived from that. Believe we'll be able to enhance value by developing that pad site. So here are a few photos. Again, this is before the landscaping had been completely redone. But this facility is open, ready to go. Actually, if you switch to the next slide, Logan. So here's kind of a newer photo here with the kind of the updated signage, with the updated kind of office area. This is where folks will come in and actually lease their unit and pick up supplies. So I think it's good to, again, just highlight, we're deal guys, right? We understand real estate, we understand the environs, and we understand how to invest in real property. We are not the best self-storage managers. And so rather than try to become the best self-storage managers, we think we're good at one day job. We don't need another. We are partnering with groups like Extra Space Storage who have all the experience in the world and are going to be able to go out there and utilize their robust marketing budgets and robust brand and market presence to fill up these facilities and optimize performance.
One thing on Extra Space, Parker, I wanted you to mention is maybe many of the folks that are on this call right now, they might be more exposed to a property manager's role. Talk just a little bit about when you think about a property manager's role on a multifamily property. Sure, you have lease up, you have maintenance, you have construction, You have reporting, accounting, those types of things. But Extra Space is actually employing folks to be on this facility. But maybe talk just a little bit about the differences between kind of a management role with Extra Space. Why is Extra Space not necessarily going out and buying this property themselves? So kind of their role just from a company standpoint, and then also what their role is on a regular basis and how that might parlay back to a multifamily property manager.
Absolutely. So Extra Space is they're going to provide the full suite of advertising and marketing, handle all of the leasing. They're going to handle when if anybody abandons a unit, they're going to handle the auctions on those units. They have two full-time people that will be staffing the facility at all times. And another thing too, when you mentioned about why is Extra Space not buying it? Well, frankly, they have an interest in doing so. Extra Space doesn't buy basically since about 2015. They stopped buying any properties that were not stabilized. Their stock price was getting hit on non-stabilized properties, and so what they've done is they've actually created a loan program. We are engaging with them, and they're one of the lenders vying for position on the loan on this property. And so they have a loan program. Well, they'll come in and do a bridge loan, get a property stabilized, and then they are, frankly, the probably highest purchaser or the purchaser that might produce the highest price. And they are interested in acquiring these properties as they become stabilized.
Yeah, that makes sense. And if folks you might see Extra Space, they are a REIT that you can invest in, and so I think their business model has somewhat changed to the fact that they are only looking for that stabilized product where they can provide those quote unquote de-risked opportunities to their investors. So I'm very confident in Extra Space. I've been on a lot of calls with Extra Space, and just listening to the analysts that they have in how they even price these units or these self-storage units on a regular basis is pretty robust, similar to maybe what Airbnb does with a pricing algorithm for short-term rentals. Extra Space does a really good job of understanding where the prices are at in the market, and they have, let's see, 920,000 customers, but I'm wondering how many properties they actually have, Parker. But we get to look at, and we're working with them on a regular basis, looking at where everybody else is on their lease up, where everybody else is from a price per square foot standpoint, and able to use that same, what I'll call data, to make our own decisions. At the end of the day, we're still asset managing this project. And so, like Parker said, we're management is not our forte per se on actually leasing these units up, but understanding where the macroeconomic trends are, understanding the data that's coming in from this property and making good decisions based on that is very, very important. So that's still our role in this transaction. We just have one of the best third-party managers to help us do that. So I'm very confident in what they're capable of doing for this project. And they're already proving it too, right?
Absolutely.
Okay, so Eng, there's your beautiful picture there. Eng is a great partner with FTW Investments with Totsi. Was going to be in town once again next week. Eng, we should probably just get you a house here or something where you can just spend most of your time in California. But when you come, you can just have a secondary home here in Kansas City. There's Parker, myself, and the silent weapon, Corey Tuck, which hopefully folks will get some exposure to here pretty soon. I love this slide because it kind of works through some FAQs. And I've got some questions either being texted or emailed to me, Parker. I'm going to just start, and Eng, I'm going to start kind of asking you guys some of these questions. But did you want to walk through some of these FAQs first?
I just want to talk a little bit about, because the investment is full, I want to talk a little bit about how we typically think about these FAQs. For this one specifically, we're trying to accommodate as many capital gain capital. We don't do a lot of opportunity zones, but we will be doing more, and they usually fill up very fast. So in respect to that, we want to make sure that we provide people the opportunity to deploy their capital gains into these great opportunities. And we've actually had people asked to come in with non-capital gains capital, because this by itself is a great investment. The return, compared to an average regular other investment is still really good. So, but we want to be very helpful for our investors, provide the best tax advantage and the best opportunities. So I just wanted to highlight that point.
Awesome. Okay, so first question is around exit strategies. So, with the capital gains that come into projects and the guidelines and taking the full benefit of qualified opportunity zones, what does our exit strategy look like? And if I'm an investor who is interested in investing in the project or in an opportunity zone project, are those able to be rolled into a new project? Just talk about the exit strategy and the different, what I'll call ramifications around exiting one of these projects. And, obviously the hold period might be a little bit longer on these, Parker, but talk about that structure.
So the way the opportunity zones are structured is that you get a deferral on your taxes until December 31 of 2026. At that point, you have a tax due on what your gain is today. So say as an example, you have a $100,000 gain today, you that gain into an opportunity zone fund, you're going to pay the taxes on that opportunity zone fund, assuming that opportunity zone fund does everything it's supposed to do. You're going to pay those taxes on the current capital gain at capital gains rates then in 2026. From that point forward, your basis in the property really is set. And so your investments, what's great about these opportunity zone investments is that the capital gains that those investments achieve in and of themselves are tax-free. Again, assuming that the fund and the opportunity zone businesses do all of what they're supposed to do. So if you invest $100,000 today, you go and pay your taxes in 2026 on that $100,000, but that $100,000 grows to $300,000. That $200,000 gain that you have there is tax-free. And so on the back end, when you get that money and you sell the property and get your cash, it's a tax-free gain. And what's really great about that, say compared to a 1031 investment, is that a 1031, you have to roll that into another property. Well, in an opportunity zone investment, you get the tax-free benefit. It's not a tax deferral at that point. That's tax-free. You also get that in a very liquid form. And so if you need to reallocate your portfolio in any particular way, you've got cash to do it.
Great. Second question here. How long will opportunity zones be around?
Great question. Eng might have an opinion on this, but the main benefit is really kind of is now until the 2026 timeline. That's because you get that tax deferral. Technically, the bill lasts until I believe it's 2042, where some of those kind of back end tax benefits are still going to be available. We think that there's going to be some kinds of extensions on this program or some adjustments to this program that will positively impact investors over the next few years. The Opportunity Zone bill was a very heralded bipartisan bill. So across the aisles in Congress, they like this bill. And I think that we're going to see some extensions and some improvements to it.
Yeah, and just to add to that, as it states now, basically, if you hold onto investment for 5 years, and by the end of 2026, December 31st, 2026, you get a 10% discount or reduction in your investment. That means that you have another year until the end of next year to invest to get the 10% discount or reduction in your taxes. I would say that the IRS has changed the law several times and has always changed it to the benefit of the investor. So I wouldn't say, I'm not going to say that it can change again, but typically what we've seen is that these things are evolving, and it usually evolves for the benefit of us.
Yeah, that's correct, Dang. And I did misspeak. It's today, instead of paying that capital gains tax on $100,000 today, you're going to be paying capital gains tax in 2026 on $90,000. And so that's a huge benefit.
Mm-hmm.
Absolutely. Okay. All right. Here's another question. Having a hard time finding a replacement property with a 1031 exchange. Well, you should probably talk to me. I could probably help you with that. But anyways, how could this be an option, or what would that look like? The question is kind of convoluted, but I think what the person's getting at is, could this be a could Opportunity Zone project be a replacement for a 1031 exchange?
Hey, Logan, can I take that?
Yeah, of course.
So I'll advise a lot of folks who are doing tender exchanges, and I work closely with Park on sort of helping them with the exchange part, but I help with the advice on the tax part as much as I can, because I've gone through this a few times. I think opportunity zones are an amazing benefit for potentially an alternative to a 1031 exchange. I think I would explore an opportunity zone benefit investment if my 1031 exchange is producing just a little bit of profit. What I mean by that is if you're selling $1 million asset and your cost base is 500, you get capital gains at 500,000, you should probably 1031 exchange that. 1031 exchange has a slightly better long run deferral strategy because you don't have to pay in 5 years or 6 years of the taxes. But if your margins aren't that much, I don't know if it makes sense to invest the whole capital stack from the previous investment into a new one just to save taxes on a very small portion of profits. So for example, if you're selling $1 million, your cost base is 950 maybe, or 900. If you have 50 or 100K of capital gains that you want to pay taxes on, you just invest that sliver into an opportunity zone. You get very similar benefits. And then you have the flexibility to then put that extra 900K of equity or whatever equity you have into it into something else.
Yeah, and I think Eng brings up some really good points there, which is that 1031s, and it's a great option. We love 1031, and it's a great option for real estate investors. I think what Opportunity Zone does do is it provides an option that is far more liquid than a 1031 approach. And it also is a good alternative in the event that you can't identify something that can fully replace that whole capital stack. And again, the whole liquidity issue is that you get liquidity on the back end of these deals on your capital gains, as well as that liquidity up front, right? In a 1031, if you had a $1 million total basis between debt and equity, you've got to go replace that whole $1 million, right? And in the Opportunity Zone, you only have to invest the capital gain portion. So you can retain the rest of your sale proceeds as cash or reinvest them in other deals, reinvest them in other assets. And so that flexibility is huge. I would say as well that if someone does have a 1031 need, we're happy to talk to folks about different options as far as tenants in common and other things go. But an Opportunity Zone is a great option, especially for someone with a higher liquidity preference.
Smiley face is what I got in return. So nice job, guys. All right. Here's an interesting one. I know you mentioned the 180-day timeline to deploy those capital gains into a project. Now, does the project have to be identified, or does it need to just go into a qualified Opportunity Zone fund, and that fund can then identify the property or project?
So first, you have a 180-day period in which to put your capital gain into a qualified Opportunity Zone fund. Then from there, the fund has 31 months to identify the property, invest the capital, and meet what they call the asset tests. And so there are certain tests that you have to do to ensure that you've improved the property, if that is the requirement, or that you've invested in all OZ assets, et cetera, et cetera. So there's some things that we can kind of get into in the nitty gritty there, but effectively you have 180 days to put your money into a fund and then 31 months to identify, deploy, and meet the requirements.
Got it. All right. This is from our good buddy, Alex Talcott, who just recently visited us here in Kansas City. If investing with a self-directed IRA or 401k, this question is in the panel, and I'm trying to discern what he's getting at here.
So here's what I can jump in and talk a little bit about investing through an IRA or a 401k or something else.
Yeah, I see what he's saying now. Sorry, Parker. If the money out of the Roth will be tax-free anyway, is there still a tax benefit to be had? So that was kind of the question. And I will go ahead and put the disclaimer that Parker, Eng, myself, Corey, Crystal, anybody on Totsi Capital or FTW Investments is not a CPA and seek that professional advice. Thank you.
Yeah, Yeah, barring that disclaimer, I would say if you're investing through one of those tax advantaged fund structures, you're not going to be eligible for some of the opportunity zone benefits. But there are plenty of great benefits to investing through those structures already.
Got it. When is your next opportunity zone project?
Always a good question. I will tell you that we are working on a few here in Kansas City right now. We have one portfolio under contract that would be eligible, and we are evaluating our options in making that an OZ investment or sort of a traditional investment. But we have a few other projects ranging in sort of their risk profile and strategies that we'll be bringing to the market here shortly.
And I want to highlight that this investment was quickly subscribed because of how it's essentially really the risk asset. You're not developing it. You're getting cash flow much earlier than you would on most traditional operating zones. And the returns are at least what I've seen in the market. Because I have, by the way, I'm investing a lot of my own capital gains. I sold a lot of Apple stock last year. I definitely want to not pay taxes on it. I know that as I've seen the market, this is usually 2 times better than what we've seen. And we have a high bar for our investments. We could probably just go and do a bunch of operating zones, but we want to make sure that this is good investments for our investors and that the returns meet our high standards.
Yeah, I mean, across the board in all of our investments, we're putting money into every single deal. And so we have a standard across TUSI and FTW where we're only going to identify opportunities that we would put money in ourselves because we are going to put money in ourselves.
It's a good point. And goes back to one that I made early on, that just because a project is in an opportunity zone doesn't mean that you should do it. So always evaluate the real estate project itself. And if it's an opportunity zone, fantastic. Okay, guys, that was the bulk of the questions that we've got, and we're coming up on our time. Do we have anything else that you guys want to cover or that we didn't speak about?
Mm-mm.
All right. Well, I think that that sums it up. If you have questions about an opportunity zone, again, if you weren't able to make the live webinar, we will make this available for you guys to watch the recording on. The slides will also be available. Eng and his team do an absolutely wonderful job of putting beautiful presentations together. Best I've seen. So Eng, thank you for that. Thank you guys for your time. This will be emailed out shortly and you'll be able to watch it whenever you'd like. And, like Parker said, and Eng said, we've been evaluating a couple new projects, a couple that are under contract. And when Eng's in town next week, we will be walking another readaptive use project in an opportunity zone. So stay tuned on that. Thank you guys. Eng, Parker, thanks for educating everybody here. And until next time, I really appreciate it.
Thanks, guys.